Welcome to this week's installment of C-Suite Snacks. My name is Steve Ronan, the host of today's webinar and the leader of Citrin Cooperman's consulting and outsourcing practices. Every Thursday at noon, we bring you snack-sized insights on a timely topic delivered by experts in the field. Today, we have a topic that's unique for this space and time. We will be discussing the latest considerations in state and local tax topics during COVID and to consider as we emerge on the other side. A few quick administrative reminders before we start. We accept questions throughout the webinar, so please look at the bottom of your Zoom screen and locate the Q&A button. Please feel free to put your questions in there as we go. Some we may answer during the course of today's discussion, and some we may reserve for the end. Additionally, we will be doing our traditional snack basket giveaway today, where a lucky attendee will win a craft basket of snacks, and we will announce the winner at the end of today's session, as we always do. In an effort to expand the series and bring you even more snack-sized insights, we have recently rebranded, and today is the launch of our C-Suite Snacks brand. And in the coming weeks, there will be more webinars available, and you'll be seeing that change come through in your emails and on our website. Finally, if you're here because you found it either on our website or through social media, I'd encourage you to sign up for our mailing list to receive an invite for our new topics every week. And please also visit our C-Suite Snacks Content Hub on our website to see the decks and recordings of all of our prior presentations and to see the presentations that are coming up in the schedule. So I want to thank you again for joining us today. It's great to be with you. And without further ado, I'd like to turn it over to Eugene to begin today's session. Eugene, over to you.
Thanks so much, Steve. So we wanted to spend a little time today just talking through the possible state and local tax considerations related to COVID. And it's been something that's evolving as the states react to the situation that we are experiencing here in COVID. And there'll be a lot of points to make and think through as we emerge from COVID. My contact information is right there should you have any questions after the seminar. A little bit of agenda on the stuff that we'll be covering today. Just digging in a little bit to the situations connected to Nexus in the remote work environment that we're all seeing here during COVID, from both a business tax perspective, including sales tax and income tax, as well as payroll considerations. So digging into the Nexus concept. So Nexus is kind of the foundation for every state tax conversation, at least from a business perspective. And Nexus is the connection to a state that allows that state to either impose an income tax or gross receipts tax or require a business to collect sales tax. And there are a number of different ways that a business can create Nexus. One is simply through deriving income from a state. Many states have statutes that are very broad and simply say that if you're deriving income from customers located in a state, that may be significant enough to create a net income tax filing responsibility or a gross receipts tax or franchise tax filing responsibility. Some states have set bright line thresholds related to the Nexus concept. For example, let's see, Michigan for the corporate income tax has a $350,000 revenue threshold. So if you derive $612,000 from Michigan customers, you may have a corporate income tax filing responsibility in Michigan. Wayfair then came along about 2.5 years ago, and Wayfair is focused on the sales tax side of the house. So historically, sales tax Nexus was only created through physical presence. South Dakota, in their incredible wisdom, said, well, wait a second, it's a different environment now. We've been dealing with e-commerce for 20 some odd years. Let's put a law on our books that says that sales tax Nexus can be created simply by making sales into our state. And the law was pressed against by a number of companies, Wayfair in the lead, and it ultimately landed in the Supreme Court. And the Supreme Court found that South Dakota's law was constitutional. And that kind of opened up the floodgates from a sales tax Nexus perspective. And almost all states with sales tax now have a a Wayfair type sales tax nexus rule. And physical nexus, this is what comes into play most importantly from a COVID perspective. Pre-COVID, remote employees could create sales tax nexus as well as business income tax nexus. During COVID, obviously, as we now have a dispersed employee environment, does that remote employee who's sitting at home during COVID create nexus for state tax purposes? It's a bit of an open question, and we'll delve into that a little bit more. The last bullet on the screen is a special federal rule that is a huge benefit for sellers of tangible personal property. And the rule says that a state cannot impose net income tax on a company if all that company is doing in the state is soliciting sales of tangible personal property. Now, that can be something that's critical to look at during COVID, because historically, maybe the company only had sales reps going into the state to drum up new sales. But in the remote work environment, there may be an IT person now working in the state who has nothing to do with solicitation of sales. There could be another sort of back office employee in the state. What happens from a Public Law 86-2 perspective? And it's a big, big deal if a corporation that has been using this protection to keep itself away from net income tax in a given state blows that protection through a remote employee now working in the state during COVID. And we'll again get into this a little bit more in the next slide. So with COVID, we've had a number of states that have graciously said that, you know what, don't worry about it. We're cool. If you have an employee working in our state during COVID, we're going to pretend that employee's not there. We're not going to attack you from a nexus perspective on the corporate income tax side, likely on the sales tax side as well. It won't blow your Public Law 86-2 protection that I just described. Pretty good. And as the bullet says, there's about 20 or so states that have given out that guidance. So super gracious. The next bullet describes those states that are a little bit less gracious. They've come out and said, well, our nexus rules are our nexus rules. We may very well come after you if you have a remote employee in our state during COVID, despite the fact that maybe that employee couldn't even go to his or her normal workplace during COVID. So it's really a pretty strong approach from these few states, and they're kind of far-flung states. I can't remember what they are offhand. Actually, I have them in my notes here. Idaho, Montana, Nebraska, not necessarily states that you're going to have a lot of people working remotely from if you are a New York-based company or a California-based company, but it's certainly possible. The remainder of the states haven't really said anything about the issue. So we're not really sure what they're going to do. Are they going to attack if they find out that there is a remote employee in the state during COVID? It's possible. So what I've been recommending my clients do is to track your employees' locations during COVID, understand where they're working, knock that up against your sales and your other apportionment information from a state tax perspective to sort out what your exposures might be from a corporate income tax perspective, from a sales tax perspective, all those things that you might be exposed to from a business perspective. Sort those things out. Try to figure out what the risks are, think it through, and you may have to take action on something, or you might be in a situation, luckily, that maybe all of your employees are working from home in states that have said you can ignore their presence from a nexus perspective. Certainly something to hope for, but don't stick your head in the sand on the issue and find out possibly later that you have a problem. And the last bullet is something as we pull out of COVID and people get their vaccines and maybe we start thinking about bringing employees back into the office. Well, I think a lot of businesses have found that they're working very efficiently in a remote environment. Maybe they will allow employees to work from home permanently and save some rent dollars. And with that comes a lot of state tax considerations. once you go to that permanent remote environment, it's very clear that that employee telecommuting creates Nexus in that other state. And that means filing net income tax returns in a state, collecting sales tax in a state if the business is selling taxable goods. It really opens up the floodgates for a very exponentially larger state tax filing responsibilities for a business. So it's something to look out for and plan for. So if you're considering going to a remote work environment for your employees, think about the state tax consequences before you commit to it. You know, really think it through, talk to your advisors about what the consequences are, and then maybe let the word out that you're open to the workforce working from home from now on. All right, going to the next slide, pulling away from the specific business taxes of corporate income tax or sales taxes and thinking about the payroll side of the house. And one of the key considerations related to this part in dealing with COVID is what we call the convenience rule. And this is actually landed on or landed in the newspapers for general consumption, whether it's New York Times or Wall Street Journal. We're seeing articles on this issue out there, and it's not just in my nerdy state tax life that we see these things, because it's very impactful during COVID. And the idea of the convenience rule is that if an employee is working from home for his or her own convenience, that instead of sourcing that employee's pay to where the employee is sitting, that employee's pay can be pulled into the, I'll call it just the headquarters state or the assigned work location. So if you have an employee who's working from New Hampshire and that employee is reporting to historically a New York office and that employee's management team is in the New York office, that his or her wages will be subject to New York tax because New York has a convenience rule. And you'll see on this slide the 6 other states aside from New York that have some form of a convenience rule. There's 2 bullets below that, the listing of the 7 states that go into some of the nuances related to Connecticut and Massachusetts. So Connecticut's convenience of employer rule only is triggered when the other state involved has a convenience of employer rule. And Connecticut was actually, they put this in place because their residents were getting harmed by New York's convenience of employer rule, where New York would say, well, your wages are going to be subject to tax in New York because of the convenience rule. And Connecticut said, well, we're not going to give you a credit for tax paid to New York because you're actually sitting in Connecticut while you perform these services. So there was a double tax situation. So Connecticut put their rule into play to kind of interact with New York's rule. And there's no longer double taxation between Connecticut and New York in this fact pattern. Massachusetts, during COVID, actually put in a convenience rule to say that if you're working from home from New Hampshire or Maine or Connecticut during COVID, that Massachusetts expects those wages to still be subject to Massachusetts tax. And that has actually, and it's a bullet a little bit further below, that triggered New Hampshire to sue Massachusetts. And there's the potential for this case to be heard by the Supreme Court. And that could stand everything on its ear. That if for some reason the Supreme Court does decide to hear the case and they rule in the favor of New Hampshire, we then have the potential for all these convenience of employer rules to be stood on their ear. And maybe we go back and say that, you know what, New York's rule isn't good anymore, and Pennsylvania's rule isn't good anymore. And it really could be a game changer. So it's something to look out for. But when you're thinking about your business and how you withhold taxes from your employees, there can be situations here where you have a dual withholding responsibility. California, in fact, during COVID has said, well, if you have an employee working from home in California during COVID, we expect those wages to be subject to California tax. And New York has said during COVID that they're going to keep applying this convenience rule. So those wages would also be subject to New York tax. And as an employer, you have a responsibility to withhold tax based upon the sourcing rules of the states involved. So you may have a double withholding responsibility, which is terrible because it sets your employee up for double taxation essentially. But we'll get into that a little bit more on the next slide. The unemployment insurance tax, just that last bullet, there's actually a provision in the, I'll call it the normal unemployment insurance tax sourcing rules that says temporary work can be ignored. So you could theoretically leave your unemployment insurance tax responsibilities in the original state, kind of the pre-COVID state, while an employee is working from home during COVID. However, I'm not really sure what temporary means. Is a year, which is what we're going on right now, is that temporary anymore? Or do we have to contemplate changes here from an unemployment insurance tax perspective? Moving on to the next slide, this is the individual side of the house. And actually I had a call with a client the other day that pretty well exemplifies the bullets on this slide. So let me go through that fact pattern real quick. So we had a client who, as an employee, worked in New York City, was a New Jersey resident, and was contemplating a move to Maine. And the employer said, fine, you can work remotely, but I need you to come to the New York office maybe 20 days a year. And with that, the convenience of employer rule kicks in because the employee is still reporting to a New York office from a managerial perspective. They're still assigned to the New York office, and they're going to be physically in New York at least one day during a tax year. So the convenience of employer rule kicks in, and the employee's wages will be subject to New York tax. Then we look on the Maine side of things where this employee, where our client was planning on moving. And Maine says, well, wait a second, we're not going to give this employee a credit for tax paid to New York because that employee, that person's working in Maine. And our resident credit rules for tax paid to other states only applies if those wages were actually earned in New York. And earned in this context means earned while you're sitting in New York performing the service. So this client of ours was saying, okay, well, wait a second. I'm planning to move to Maine. I just put my house on the market in New Jersey, and you're telling me I'm going to be subject to double tax? And I said, yeah. I mean, there are ways to work around it potentially, but we really have to rejigger things from an employment perspective, or maybe where his assigned work location is, to try to work around the New York rule. You could maybe just wait and hope, hope that the Supreme Court decides in favor of New Hampshire, so the convenience rule maybe goes out the window. I wouldn't necessarily wait and hope for that. Excuse me. So it's certainly a lot of stuff to look out for from a payroll perspective on the individual side of the house. Transitioning over to residency. Sure, a lot of you have heard a lot about residency issues during COVID. Again, these are issues that have been landing in the business sections of newspapers, so it should be familiar to everyone and maybe personally impactful. So just to set the table real quick on residency, the general terms are domicile and statutory residency. Domicile is where your true home is. And if you're domiciled, you're a resident of the state, and you're subjected to tax on your worldwide income. Statutory residency means different things in different states. For New York purposes and a lot of the East Coast states, it means that you have a home in the state for either substantially all of the year or all of the year, and you're in that state for greater than 183 days. On the West Coast, California in particular, they have this temporary or transitory test where if you're in the state for more than a temporary or transitory purpose, then you could be deemed to be a resident in that state as well. Again, you would be subject to your tax on your worldwide income as a statutory resident, the same as if you were domiciled in the state. COVID, as you can imagine, created all sorts of chaos where if you had two homes and you evacuated essentially your primary home to stay in your vacation home on the countryside or at the beach, there's the possibility that your domicile would stay the same in your true home because you haven't really changed anything. Your plan is to return to your true home after COVID, but at your vacation home, you may be deemed to be a statutory resident in that state because of the 183-day test. So it was certainly something to look out for. People fell into this trap in 2020, and it could lead to double taxation in certain scenarios. So very problematic. And the last bullet on the screen is just about people reconsidering their lives, right? A lot has happened in COVID, even though a lot has not happened in COVID as we all sit at home for a year straight. But people have really reconsidered where they want to live. And there may be opportunities to save state taxes by changing your residency. Next slide. I touched on a lot of this stuff already. The last bullet is something to keep in mind as you potentially change your residency, that there could be estate tax issues. About 15 states have estate taxes. So as you make changes and to your state residency and you're thinking about today, you also have to be thinking about your future and potential death and estate tax issues. Going to the last slide in the deck for me, these are the things from a residency perspective that are kind of the hot issues that we're thinking through. The changing the domicile issue on the first bullet, taking off and landing. The typical fact pattern is the New York City domicile, vacation home in the Hamptons. I wasn't in New York City for greater than 183 days. Do I really have to file as a New York City resident for tax purposes? The answer is generally yes, because you're just leaving your New York City domicile temporarily. You're not really landing in the Hamptons, say, and making that your true home and extinguishing ties in New York City. Your eventual return will be to New York City, so your domicile stays in New York City and you continue to be subject to New York City tax. The second bullet is about auditing, and it kind of connects to the first part about taking off and landing. But the tax departments across the country, they may wait a couple years before they audit these issues. And if you end up boomeranging back to your true home within that 2 or 3 year period before the state audits, it's going to be pretty clear, or at least it's going to be tough to fight, that your intent was actually to return home to your original place of abode. So it's something to watch out for. The states are going to have this 2020 hindsight in doing their audits if they just wait a couple years. One other thing to think about when you're changing residency is whether the impact of that change will really change your state tax bill. So if you have income that still remains sourced to, say, New York, but you move to Florida, it may not change what your bottom line tax bill is because your income will still be sourced to New York, even though you're a non-resident of New York. So something to think through before you change your complete lifestyle. Think about what the bottom line tax dollar will be after you make this change. A couple more audit considerations in the fourth and fifth bullets on the slide. New York and California, they've had very robust audit regimes from a residency perspective. There's a question as to whether they'll be able to get to everybody, right? There are many, many taxpayers who are changing residency now. Will they have enough auditors to keep up? I think they will. It's not that hard for them to flip out an audit notice just to get the ball rolling, and eventually they'll get through the whole audit process. But it's, again, something to consider. I wouldn't necessarily play the audit lottery though. Be ready for a challenge. In other states that haven't really had much of an audit regime during the years, will they change that? Connecticut and New Jersey, we don't see a lot of residency audits, but I think it could be an opportune time for them to change that because so many taxpayers are changing their residency. Now, the last bullet on the slide, we've spoken a little bit about some of those states that have been gracious from a Nexus perspective, where they've said, you know what, we're not going to worry about remote employees in the state. Don't worry about it. That's not going to create Nexus. We haven't seen any state be so gracious from a residency perspective. So if you trip over one of those statutory residency rules where you're at your vacation home for greater than 183 days during 2020 or 2021, you might expect a challenge. And it may be hard for a state to identify that situation, but if the state dives into property tax records and understands that you have a home in the state, they again could easily flip out a notice to you to just ask the question. And then once they ask the question, you've fallen into the trap. So it's certainly something to look out for. And we wanted to see if there were any questions that popped up. Steve, did anything pop up during my speaking time there?
We had a couple come in, Eugene, so thank you.
Okay, great.
And I would like to remind everybody just to use that Q&A window at the bottom of the Zoom screen to submit questions that we can address right now for a couple of minutes. So one of the ones that came in was about New Jersey. Did New Jersey also put the COVID rule in place?
And the COVID rule, if what is meant by that is that they kind of said that, hey, forget about it. You don't have to worry about your remote employee in our state. They did. So they were pretty gracious about it. They've also, because of their general resident credit regime and the interplay between New York and New Jersey, they've been, over the years, they give out the resident credit essentially. So if you fall into the convenience of employer rule, where your wages are pulled into New York, even before COVID or during COVID, New Jersey generally gives that credit. So that's a good thing. New Jersey's been pretty helpful.
And I get the other one just is kind of more of a general process question, which is that if a company has not started to look at changes to residency impacts yet, where do they start and what does that process look like?
Yeah, I mean, you're playing a little bit of catch up now, but I think tapping into understanding where your employees were working from, March 15th on in 2020 is the first step. Try to gather that information, talk to advisors about what the impact might be. And, ultimately we may figure out, well, maybe there's nominal impact or nominal exposure, but we want to be aware of that and be able to react to it thoughtfully and not, get an audit notice a year from now and then have to scramble to put the pieces back together.
Great. And one last question for this session, Eugene. Is the convenience rule an option to elect, or is it a must that you have to comply with it?
It would be nice if it was an option, but it is absolutely mandatory. It's a statutory or regulatory thing across the states that do have the convenience rule. There's no opt-out.
Great. All right. Well, Eugene, thanks very much.
Sure.
Eugene's contact information is up on the screen right now. Please feel free to reach out to him directly with any additional questions you have on this topic. And really appreciate you joining us today, Eugene. Thank you.
Yep. Thank you, Steve.
So that closes this week's C-Suite Snack session. Thanks everybody for joining. Next week, we are continuing our COVID sort of HR talent series with nationally renowned HR and talent expert David Lewis, who will join us to talk about a roadmap to reopening your post-COVID workplace questions answered. And I know he's been doing that particular presentation with a number of different audiences and has a good load of questions that might be on your minds as well. So would encourage you to attend that. The week after that, we're going to be joined by Ash Bendel from ADP. He and I are going to talk about a data-driven approach to reducing labor costs and improving employee engagement. And then coming up on 4/1, we'll be talking about how people are making money in cryptocurrency right now with Mark DeMichael. And on the 8th of April, we will be talking about how to respond effectively to cybersecurity incidents. So loads of good topics coming up. If you are not on our mailing list yet, I encourage you to sign up. Check out our website for future sessions. For today's snack basket giveaway, congratulations to Anastasia Cam. You are the winner of our giveaway. So somebody from our team will be reaching out to you to get shipping information. Folks, once again, thank you for joining us today for C-Suite Snacks, a half hour every Thursday on a new topic every week. We appreciate you joining. Check out the video and the deck that we send out afterwards. We hope you will join us for future webcasts, and we wish you a great rest of your week and a weekend. All right, take care. Thanks again.